The leverage right now is absolutely astounding because Wall Street does not believe that these prices are going to stay here. I mean, there was a poll, what bubbles are we in? And both gold and silver made the poll. I mean, I forget the percentages, but like 30 or 40% said that, yeah, gold and silver are both in a bubble, which is a joke. I mean, gold and silver are not even close to a bubble, not even close. In my opinion, gold, the chances of gold not trending to $7,000 or higher is probably less than 20%. So Wall Street's got their percentages out of whack. They're ignoring the gold miners. They're ignoring gold. They're ignoring the trends. They're ignoring the fires that are burning around their house. And yeah, these stocks are unbelievably cheap.
Gold racing towards $7,000 and silver reclaiming triple-digit territory may sound dramatic. Yet some market observers argue the trajectory is far from unrealistic. Beneath the volatility, they contend, the foundations of the current precious metals cycle are stronger than many investors realize, shaped by years of structural imbalances, rising deficits, and tightening physical supply. For them, the real story is not the recent pullbacks but the magnitude of the bull market that has already begun. Durrett, mining stock investor, analyst, and author, argues that skepticism from major financial institutions has created one of the most unusual market conditions in decades. Polls circulating on Wall Street have even suggested that gold and silver could be in a bubble, a claim he views as disconnected from underlying fundamentals. From his perspective, the probability that gold fails to trend towards $7,000 is relatively small, largely because monetary expansion, persistent government deficits, and geopolitical tensions continue to reinforce demand for hard assets. The current phase of the market, he explains, did not emerge overnight. It developed through several defining moments that gradually confirmed the strength of the trend. The first turning point occurred in early 2024 when gold decisively broke above the $2,000 level and surged higher over the following months. Silver followed much later. For more than a year the metal lagged behind gold, trading sideways while waiting for confirmation of the broader trend. When silver finally surged from around $35 to nearly $120 within months, it represented another milestone in the evolving cycle. According to this interpretation, the delayed confirmation from silver helped ignite a powerful rally in mining stocks, many of which produce both gold and silver as part of their operations. If you're finding this analysis helpful, take a moment to like this video, subscribe to the channel, and hit the bell icon so you never miss timely updates on gold, silver, and precious metals market.
I've been saying this, that the most important chart for gold and silver is the S&P 500. The gold and silver absolutely love a positive S&P. The S&P goes up, gold and silver go up. They absolutely love it. I mean, you can go, they've been correlated quite strongly since February 24. Once gold became a bull market, gold loves a strong stock market. Sometimes it corrects even when the stock market is still going higher, but then it turns around and rips back up. It's like, oh, you guys are up there? Oh, here I come. Let me go join you guys, right? And you get an all-time high in gold. I mean, gold went up $3,500 in 2 years. So you know it was ripping higher. And so was the S&P. So they've been correlated. Gold loves a strong stock market. It doesn't really like a weak one. And so we've had a 5% sell-off in the stock market, and gold's off 10%. No surprise. Silver's off 33%, but that was because in January, silver absolutely went bonkers. So it was just, it got overbought. And so it's basically going back to its mean. But it's still, I don't think silver's going back to 70. It might. I think 72 will hold. It could go a little lower than that. I don't think it'll go much below 65, but anything below 70 will be short-lived. Not so much for the stock market, but gold and silver will bounce. Those guys, you can only push them down so far. Then you'll get a decoupling. I've been waiting. That's the final battle I've been waiting for, is for the stock market to roll over, the onset of a recession, and then gold and silver, they go higher because the fear trade kicks in. So what happens is, initially when you get sell-offs in the stock market, for some reason, people don't run to gold as a hedge. They should, but they don't. Historically, they never do. And so, this was kind of my arguing with Michael Oliver. Other than that, I kind of agree with him. He's always said, don't worry about gold and silver going down. Don't worry about the miners going down. Well, we keep seeing the miners go down. The miners are down 17% right now. So I've always been warning people until we win that final battle, until we get to decoupling, expect downdrafts, expect deep corrections. And I've said anywhere from 20 to 30%, 15 to 30%. In the miners. So now, yeah, we're down 17. Expect, we could easily, I don't think you'll go down more than 30% in the deepest correction. I think we went down almost that much in October, and then we ripped back 4 to 6 weeks later. We got that correction completely reverted. And so we will see, these corrections with the stock market. Now, the key here is this the last? Is this it for the stock market? Is this the end? Is this the rollover? Is this where it just slowly, now we get higher lows? Is this a higher low scenario? I think quite possibly it is, but maybe not. I've always thought going into this year, there's going to be a second half. The stock market and the economy's real problems is the second half of the year. And the reason why is because Trump's going to run out of, basically mojo by July because of the lame duck coming up. So if he can't get he can only, like the Clarity Act, for instance, he's got to get that Clarity Act passed before July. Because once you get to June, once you get to August, they do the August recess, they come back from that recess, you're not going to get anything passed for the election. So he has very little time now to get anything passed. And then tariff laws, if he wants to implement any new tariff laws, he's got to get that done before August. So tariff laws and the Clarity Act, I think the time collection. The other thing he's got to get passed before August is a new budget. And he wants to increase defense spending. Good luck with that. He said he wants to have $1.5 trillion defense budget. Good luck with that, right? Where are you going to get $500 billion? You're going to increase the deficit to 2.5? Where are you going to cut $500 billion? I mean, I thought that was hilarious. I mean, it's almost comical. There's no way in hell they're going to get a $1.5 trillion defense budget. I think the reason why he did the 1.5 is he doesn't want it cut, right? He wants an increase. 1.1, 1.2. I think 1.2 is about as high as he can go, but I don't even think he can get 1.2. So he's trying to get an increase, 1.1. I think it'll be somewhere between 1.1 and 1.2 is my expectation. He's starting at 1.5, but he wants to increase the defense budget. We really don't have the money, so that, deficit's coming.
Despite the strong upward movement, volatility has remained a defining feature of the market. Gold has experienced several corrections since its initial breakout, including pullbacks of roughly 10 to 18%. Silver has been even more dramatic, retreating more than 30% after its rapid rise earlier in the year. These declines, however, are viewed less as signs of weakness and more as normal resets in a fast-moving bull market. A key factor shaping short-term price behavior is the relationship between precious metals and the broader equity market. Since early 2024, gold and silver have often moved in tandem with the S&P 500. When stocks rally, metals frequently follow, though sometimes with brief delays. Conversely, when equities experience corrections, precious metals can temporarily decline as liquidity tightens across financial markets. Recent events illustrate this dynamic clearly. Tensions in the Middle East briefly raised the possibility that Iran could close the Strait of Hormuz, a scenario that would threaten roughly 20% of global oil supply. Crude prices surged and inflation fears intensified, yet gold slipped more than 1% during the same period. At the same time, silver dropped over 4% toward $80 per ounce as a strengthening US dollar and fading expectations for interest rate cuts weighed on commodity prices. Let's get back to the video.
Yes, and the margins. So it's more the margins than the price of gold and silver. The key for valuations on gold and silver mining stock is the free cash flow multiple. So that's basically correlated to most stocks. They use PEs, but PEs don't work as well as free cash flow in the mining business because it's a cash business. You need cash to do exploration, do sustaining CapEx, to buy mines, to build mines. It's a cash business. You're constantly, burning cash. But you're trying to build cash. But, balance sheets are really important in the mining business. And so free cash flow is what I look at. So I use the free cash flow multiples. So right now, they're ridiculously low. And the reason why they're ridiculously low is because gold and silver prices have blasted off. We had low oil prices, so we had low cost. You have these massive margins, anywhere from 2,200 to 3,000, depending on a company's cost structure. But the average is around 2,500 right now. That's pretty massive. I just did Newmont. They were $2,700. So 2,700 times 5.3 million. It's $14 billion in free cash flow annually. And their debt is like $5 billion. So they can pay off all their debt this year. And they have like $5 billion in cash on the balance sheet, which they don't need. I mean, they could take their cash down to $2 billion, which would be fine. So they're going to end up with, they could pay off all their debt and still have, 3-4 billion cash on their balance, more than that on the year's end. So Newmont's going to be able to pay out high dividends, and they're low right now, and do buybacks, share buybacks, and then have a beautiful balance sheet by the end of this year. And they're trading at a 9 multiple. It's ridiculous. They should be trading an 18 multiple at these margins. For me, I've been doing this for 20 years. For a very high quality major like Newmont, a fair free cash flow multiple is about 15. If their margins were about, say, 2,000. That would be a fair multiple at 2,000 margins, but they have $2,700 margins, so they should be getting higher than the fair value. So the average and it's not just, I use Newmont because they're the largest ones, but it's the same for all of them. They're all crazy. The average free cash flow multiple right now is about 7 to 8, and the reason why is because there's a lot of these miners, like in Africa or South America, Central America, they don't get a multiple of 10. A lot of them get 2, 3, 4, 5. They get low, really, really low multiples. And their forward multiples are even lower, which is kind of insane if they have any growth. And so right now the multiples like 7 and 8, it should be 14, 15. I've been waiting for this for a long time. So it's hard to, encapsulate, in a few words, a few paragraphs, what's happening today, because this has been building for years, right? This is what we're experiencing today is an outcome. I always say that there was basically 4 battles, and we've won the first 3. So the first battle was in February of 24, when gold was at $2,000, $2,050, and gold basically ripped higher in March, April of 24, and gold broke out. And that breakout was very apparent to me. I turned uber bullish in the first week of April. And since then, gold went up $3,500 in 2 years, which is kind of insane, right? And now it's corrected back twice. Actually, it's corrected 3 times. Corrected in October. I think it was a 12% correction. And then it corrected again in January, and that was, I think it was an 18% correction. And we didn't go all the way back, but we recovered quite a bit. And now we're down again 10% off the highs. We've had basically 3 corrections from that breakout. So that was okay. So battle number 1 was in February, where gold won that battle. Second battle was in August, when silver broke out. So silver was at $35 in August, and it went all the way to $120 in January, and now we've corrected 33% off the high, quite a correction there. And so that was that, but silver won that battle. When silver broke out in August, that was correlated to the breakout in February of 24 for gold. They were both substantial breakouts. So it took silver 18 months, which is kind of crazy. It took a year and a half for silver to confirm that gold breakout and say, okay, I'm ready to go with you. And so that was the beginning, in my opinion, of this bull market. for the mining stocks. So the mining stocks were also, because silver and gold are so correlated, without silver, the silver miners, because most of the gold miners also produce silver.
The mining sector presents another dimension of the story. According to Durrett, many mining companies are generating extraordinary margins due to high metal prices and relatively stable operating costs. Some of the largest producers are producing billions of dollars in annual free cash flow, yet their valuations remain modest compared with other industries. Instead of traditional price-to-earnings ratios, analysts often focus on free cash flow multiples to assess the value of mining companies. In many cases, these multiples remain unusually low. While a high-quality mining company might historically trade near a multiple of 15 times free cash flow, several large producers currently trade closer to 7 or 8. This discrepancy suggests that the equity market has yet to fully recognize the profitability generated by current gold and silver prices. Looking ahead, the final stage of the cycle may depend on whether precious metals eventually decouple from equities during a broader economic slowdown. Historically, metals sometimes fall alongside stocks in the early stages of market stress before rising later as investors seek protection from financial instability. If gold continues climbing while mining companies remain undervalued and geopolitical tensions intensify, could the next phase of the precious metals cycle become the moment when investors finally recognize the scale of the opportunity? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.